Welcome to The Explainer, where we break down complex topics into clear, concise presentations.
Okay, let's get right into it. We're looking at Gala Precision Engineering's latest results, and it's a classic story. We're seeing some really strong growth, but that growth is coming with some pretty significant expansion pains. All right, so to really get a handle on what's going on with Gala, we're going to break it down into 5 key parts. First up, we'll look at their growth story. Then we'll dive right into the numbers, the Q2 financial highlights. After that, we'll check out their big Chennai expansion. Then we'll see where the money's really coming from by analyzing their business mix. And finally, we'll wrap up with the outlook and the major challenges they're facing. First things first, let's get a quick overview of the company itself. So, who is Gala Precision Engineering? So, Gala is basically a super specialized manufacturer. They make these high-quality, precision components. Think of the really critical parts that major industries all over the world can't do without. They're serving huge sectors like renewable energy, industrial, and mobility, with operations in India, Europe, and the USA. We're talking about a company with over 175 global customers and juggling around 750 different products. So yeah, they're a pretty key player. Okay, so that's what they do. Now for the big question. How's the business actually performing? Let's look at the numbers, because this is where that growth story really starts to pop. And wow, the top-line results are seriously strong. Just look at this. Revenue for Q2 shot up by 40% compared to last year. We're talking going from about 51 crores to over 71 crores. I mean, that is a huge jump in just 12 months. And it gets even better when you look at the bottom line. It's not just sales that are up. Their net profit exploded by 59% year on year. That's incredible. It shows they're really efficient at turning those extra sales into actual profit. And this wasn't just a one-quarter fluke. If we zoom out and look at the first half of the year, their own report shows the trend holds up. You can see it right here. Revenue's up 29% and net profit is up 30%. So that strong Q2 is definitely part of a bigger, sustained push. But, it's not all sunshine and roses. The CFO, Sriyamas Girdhar, pointed this out. He said that their profit margins took a bit of a hit. Why? Well, things like raw materials and labor are getting more expensive. And this is a really key point, right? It shows us the hidden cost that comes with growing this fast. So you have to ask, what's the engine behind all this growth? Well, a huge piece of the puzzle is their brand new facility in Chennai. It's just getting started and it is ramping up fast. I mean, this Chennai plant is a really big deal for them. They're focusing on new stuff like high-tensile fasteners and bolts. They've already gotten the green light from over 10 big global customers. And get this, sales from the plant went from 82 lakhs in September to over 3 crores in October. 1 month. That is an insane scale-up. And they're just getting started. Phase 1 is aiming for 60 crores in annual revenue. Okay, so the Chennai plant is clearly a growth driver, but let's take a step back and look at the whole picture. How does this fit into their overall business? Let's break down the revenue and see where it's all coming from. What's really interesting is how balanced their business is. You can see here, renewable energy makes up 38%, but the industrial and mobility sectors are right behind. This is smart. It means they're not putting all their eggs in one basket. If one industry has a tough year, it's not going to sink the whole company. And it's the same story when we look at where they're selling. Yeah, India is their biggest market, no surprise there, making up 65% of sales, but a solid 35% comes from exports, mostly to Europe and the US. Again, this is a great way to spread the risk and tap into some really big developed markets. Now, let's talk customers. They've got 175 of them, but there's a bit of concentration here. Their top 5 customers bring in about a third of the sales, and the top 10, they make up about half. Now, look, that's not totally unusual for this kind of business, but it definitely means keeping those big clients happy is absolutely crucial. All right, let's wrap this up by looking at what's next. We'll check out management's guidance for the future, and then we'll dig into a key challenge they're facing, something that, came up a lot on their last earnings call. So, the folks at the top are feeling pretty confident. They're sticking to their full-year forecast, targeting revenue growth of 20 to 25%. They also think those profit margins we talked about will bounce back to somewhere between 17 and 19%. And they have a good reason to be optimistic. Their order book is looking strong, with about 75 crores in orders already lined up. But remember those expansion pains I mentioned? Despite all this good news, there's definitely some pressure building up. And this is the other side of that rapid growth coin. And here it is. This number is at the heart of the issue. 129 days of inventory. Think about that for a second. That's more than 4 months' worth of sales just sitting there as stock. And that's higher than what they usually carry. All that stuff has to be paid for up front, and, well, that's where the cash starts getting tight. And you don't have to take my word for it. It's right here in their cash flow statement. See that? A nearly 23 crore increase in inventory. That's the main reason their cash from operations is getting squeezed. This is where those growing pains really show up in black and white. So, what does management have to say about this? Well, they're saying this is all part of the plan. It's not a mistake, it's a deliberate choice. They're building up all this inventory on purpose to feed the new Chennai plant and support new products. Essentially, they're sacrificing some cash flow right now because they're betting it'll pay off big time with growth and profits down the road. So that really brings us to the big central question, doesn't it? Gala is pouring fuel on its growth engine, but that fuel is cash that's tied up in inventory. The real challenge for them going forward is going to be balancing this super aggressive expansion with just basic financial stability. It's the classic tightrope walk for any high-growth company.